Hi and welcome to Swissquote's Daily Market Talk. It's Monday, March 17th. The Chinese equities kicked off the week with encouraging economic data and stimulus news from the Chinese government. The Germans reportedly agreed on a massive spending plan, while Brits are dealing with growth slowdown at home. The Federal Reserve and the Bank of England are expected to keep their policies unchanged when they meet this week, while the Swiss National Bank is expected to cut by another 25 basis points. So the new week starts on a positive note for the Chinese equities as a set of Chinese data released earlier today looked better than expected by analysts. The fixed asset investment, for example, unexpectedly accelerated in February. Then growth in industrial production slowed less than expected by analysts, but that is a slowdown that is mostly due to the Chinese New Year break. By the way, it's nothing more than a seasonal slowdown, while the growth in retail sales accelerated to 4%. That's also more than expected by analysts. The unemployment rate, on the other hand, and the worries regarding the property crisis in China and the shrinking population also remain on the back of investors' mind, and that despite the AI-led boost that we've been seeing in the Chinese equities so far this year. So to address the issues while the momentum is in favor, while the Chinese authorities actually pledged to provide some more support to stabilize the country's stock and property markets, support the wages growth in a sustainable way, and more importantly, will do something to boost the shrinking birth rates in China. So those are all kind of measures, things that require restoring confidence. So we will see how well the Chinese authorities succeed in doing that and how fast, but investors are attentive this year. Sentiment has been improving and it looks like the right time for the Chinese authorities to give the right dosage of policy push to keep things going toward a better direction. So the Chinese government obviously knows that the real potential today is probably lying within China and not necessarily beyond its borders with all the tariff and trade war. So boosting domestic sentiment to improve spending, to reverse the property crisis, and maybe even to stabilize the aging population are the best options for China when the international uncertainty looms. As such, the Hang Seng is up this morning by around 0.70% at the time I'm talking here, although the CSI 300 index shows some reluctance this morning to extend its Friday's gains that were nearly 2.5% on Friday, remember, before more details are unveiled from the Chinese authorities this afternoon about their plans to boost economy in China. Then, oil gained on Chinese stimulus prospects this morning and on the back of encouraging data, but the gains here were mostly and fully given back as a worsening trade war, its negative impact on global growth prospects, the possibility of a potential end to the Ukrainian war, and also OPEC Plus production restoration plans from April on actually keep the upside potential limited in US crude near the $68 per barrel level, with potential of a further fall toward the $65 per barrel level in the short run. Now, speaking of government boosts, good news also came from Germany last Friday. Mr. Friedrich Merz reportedly reached an agreement with the German Greens to unlock a 500 billion euro worth of debt finance spending bill on infrastructure and defense. The latter is obviously pushing the German yields higher since these discussions are on, with the 10-year bond yield in Germany testing the 2023 peak. If broken, would send the borrowing cost in Germany to the highest level since 2011. So the euro continues to see support on the expectation that this extra spending will boost growth and even productivity in Europe and could also boost inflation to some extent, which could then require a more restrictive European Central Bank policy than otherwise, which is also positive for the euro's valuation. As such, the euro dollar has its eyes set on the 110 psychological mark, And the euro pound is now challenging its 2-year descending channel on this improved growth prospects for the European economies, for the continental Europe, versus the deteriorating numbers and figures across the channel. Because if you missed the latest figures, well, Friday's data from the UK looked quite bad. It looked sad, actually. The industrial production fell more than expected, and the GDP growth turned negative in January. The British government's plans to raise taxes to improve spending are suspected to play a role in the growth slowdown of the UK right now, and the rising gilt yields only narrow the prospects of further government spending and growth for the UK's economy. So the UK is going in circles somehow. The UK's ability to get itself a special treatment from the US and this growing tariff war across the world doesn't help either, and the Bank of England is expected to maintain its interest rates unchanged at this week's monetary policy meeting. So it's not looking good, but against the US dollar, the pound's outlook remains positive still, because the pair could well succeed in another attempt to clear the 130 psychological offers as the growth prospects for the UK's economy deteriorate less aggressively than the growth prospects for the US economy. And as you understood, the valuations are very much impacted by the changes in growth expectations of the moment, which in return are highly influenced by the White House policies, especially its geopolitical and tariff policies. Now, the good news is that the rising yields in the UK may slow the UK government's headroom to spend and weigh on growth expectations, but the European Union's spending plans weigh heavier for the sentiment in equities right now than these rising yields. As such, the European Stoxx 600 index actually remained well bid last week near its 50-day moving average level, while the FTSE 100 index in the UK managed to rebound above its 50-day moving average as well, after having spent 3 trading sessions below this level last week, while across the Atlantic Ocean, the S&P 500 tipped a toe into the correction territory last week following a 4 straight week and a 10% sell-off on the tariff shenanigans. Now, Friday's session was looking better for the US equities as the oversold conditions there attracted some dip buyers, and also the US politicians agreed to avert a potential government shutdown. Because in fact, the last thing the American Democrats want right now is a government shutdown, just to give more power to Donald Trump. But besides that, besides the fact that we avoided a US government shutdown, the news were not great from the US, mind you, because the consumer sentiment tanked to the lowest levels in the US since November 2022. While the long-term inflation expectations spiked to the highest level since 1993. Yes, since 1993. That's the worst possible combination of data for market sentiment. As such, Friday's rebound that we see in the S&P 500 and US indices may not lead to a sustainable rebound in the equity markets, and the US equities are probably set to extend their losses. Downside correction could extend all the way down to 5 to 10% more sell-off from the actual levels. Now, all eyes are on the Federal Reserve this week. The Fed is expected to maintain its interest rates unchanged with a 99% certainty, according to the activity on Fed funds futures. But the Fed's dot plot and the Fed President Jerome Powell's comments after the decision will maybe give some hints to investors and the markets how the Fed is planning to navigate the tariff war that's hammering the US economic prospects. The US dollar is under pressure these days, as you know, while investors buy gold each time they hear the word tariff. So, the yellow metal traded above the $3,000 per ounce psychological level on Friday for the very first time in history. The Bank of America said that the price of an ounce could increase all the way up to $3,500 per ounce on the actual geopolitical uncertainties, and Bloomberg said that gold is still far from its inflation-adjusted peak of 1980, which in today's prices would stand near $3,800 per ounce. So this is all for this Monday. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn, and also on our new WhatsApp channel, Threads, Telegram, and Blue Sky for regular market updates, and subscribe to our YouTube channel for daily market comments. And also please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.